Well, good afternoon, everybody, and welcome to the final bull session of calendar 2020.
Yay!
Hey, it's been a better year than we give it credit for in some ways, and worse in others. But there are it's certainly an opportunity to learn from what we've experienced and move forward. My name is Mark Robertson. I am founder and managing partner of Manifest Investing, and I'm joined here by my dear colleague, Ken Kavula. Say hello, Ken.
Hi, everybody. Great to be here, and great that this year horrible is finally ending for us. So,
Yeah, it's been kind of a tough one. Kim's not going to be able to join us this afternoon. Hugh was going to try to sneak, by the way, he refers to this as a morning meeting. Being from Southern California, this is a morning meeting for Hugh, so he thought he might be able to sneak out and join us. But we're going to talk a little bit about the closeout of a year and the beginning of a new year, and then a reminder from Ken Kavola a few years ago that it really is just another page in the calendar and the ball drops and all that other stuff. And yeah, it's cool. It marks a transition. But by the same token, it's probably been a better year than we give it credit for in many different ways. And I say that as having one who lost very dear family members this calendar year. It's been certainly a year to remember and forget when it comes down to it. All right, so let's go ahead and get underway. Make sure I've got everything up and running. You know, the disclaimer, no investment recommendation is intended. We will talk about a couple of specific companies. Please do your own homework. When we get together for these sessions, whether they're bull sessions or roundtables or any other time that the Mid-Michigan chapter of Better Investing or Manifest Investing come online and talk about investing, it really is for illustration and demonstration, and please know that. We will express opinions, in some cases fairly considerably well-held opinions. And sometimes we own stocks and we try to remember to disclose that when it happens. But again, keep in mind that this is about demonstrating the principles of the modern investment club movement and the lessons that we've learned over the last 8 decades, believe it or not. 8 decades of really solid lessons and experiences accessed by members of our community. There is a roundtable tonight, so we'll keep the session a little bit short, hopefully. You never know once we get going, but we'll aim for that. If you would like a reminder about the monthly roundtables that are co-sponsored by Manifest and the Mid-Michigan chapter of Better Investing, please send an email to nkavula1@comcast.net. Natalie will not inundate you with emails. She'll simply make sure you're aware when the educational opportunities present themselves. If you have follow-up questions or would like a copy of the slides, you can send an email to markr@manifestinvesting.com, and I'll do my best to get it back to you. I get quite a few copies for requests for slides. There are also many Manifest Investing subscribers in the audience, and I just remind you that in the forum, those slide decks are always posted in the forum, in this case under the general topics area. Anything else you need to add to that, Ken?
Nope, sounds good, Mark.
All right. Here's just a quick reminder that we've been getting together on Tuesdays just to kind of kick around some topics, in some cases talk about what I have seen in the weekly update batch, the 1/13th slice of the companies followed by value line that we basically do a quick audit on every week. Every once in a while we see something interesting. We were just talking with Len Douglas in the pre-session about the insurance company Unum, UNM, and some stuff that we'll take a look at and see if there's a learning opportunity. But there's a number of topics which we will be covering in future weeks, and we'll do that. For now, let's just talk for a moment about New Year's resolutions. And this is one of my favorite fun facts that you can use at your New Year's Eve parties, whether they're on Zoom or Skype or across the street with masks on, whatever you're doing. Are you going out for New Year's this year, Ken, at all?
No, we're not.
Are you gonna like?
We haven't been out of the house socially, Mark, in probably in 8 months now. So no, we're not going out socially.
So have you scheduled like any drive-bys where you'll sit in the windows and look and see people driving by? And
We'll probably Zoom or we actually use Skype and go to meeting, but we'll probably use one of those things and talk with the grandkids a little tiny bit. But no, we won't see anybody face to face. Might go down to Canton in the new year where my sister lives and spend some time with her. But other than that, we're still kind of keeping to ourselves till we can get that shot in the arm.
you know, I'm not much for resolutions. I've been in the middle. I've actually lost 20 pounds in the last 2 months. So I guess it's a resolution in progress. I stopped smoking every year because I've never smoked a cigarette in my life, and I want to count that as a win every year. I'm not sure that I really spend a whole lot of time with resolutions. We'll give you a chance to chime in a second, but I will confirm this fact. I used to work for Booz Allen and Hamilton on the management consulting side, and we used to do a lot of work with the chocolate companies, including Cadbury and a couple of the domestic chocolate companies, and they are so good at tracking the consumption of chocolate worldwide. And sure enough, they can put out these charts that show that basically diets and abstinence from chocolate lasts about 3 days into the new year, and that certainly says a lot about the human condition, I think, Ken.
We have a dining room full of goodies. We got the normal number of goodie presents from people throughout the country, and we appreciate every single one of them, but the dining room table is just overflowing with goodies that will take us probably until July to consume if we decide to consume them all. So
it's tough. I will go back a slide, though. I mean, if I did have a resolution for this year, and in fact, it goes back 25 years ago when I was with my investment club in Chicago, we made a collective resolution to really try to come to an understanding of the stock selection guide. So again, you're talking mid-1990s in Chicago. And that first statement, I think the lessons are still not yet fully understood, but we're working on it. We mean that. And we'll close today with a quick reminder and an invitation to the work we've been doing on projected return on value, because we think that might hold some fairly interesting potential in this area. So you're going to see us cover that during the first quarter. And basically the promise and commitment is to open it up wider, do some beta, and basically bring that to life if it's going to be something of value to us. And it's not going away as a subject here at Bull Sessions anytime soon. All right, one last time around the park for this chart. I know a lot of you have seen it. Some of you haven't, so I thought we would just, for one last time around the park, talk about this one a bit. This is a look inspired by that set of questions we've been answering over the last 2 weeks in Bull Session. It's a look at the 5-year performance of a number of entities, including Tin Cup, which is a model portfolio that we take care of at Manifest Investing. That's actually checked in at about 17.5% over the trailing 5-year period. And that's kind of fun, especially when you contrast it to what's been going on with the stocks in the Value Line Investment Survey Standard Edition. And they've actually been, at least when you get outside those juggernauts up at the top, and by juggernauts, I'm talking about the ones Kramer talks about all the time, you know, Microsoft, Amazon, Apple, Facebook. What am I missing, Ken? Google,
yeah.
Yeah, all of those stocks have been just going gangbusters. Well, while they've been doing that, the rest of the 1,700 stocks have actually been kind of in the dumps, especially for the last couple of years. And so for the first time in a long time, we see the Value Line arithmetic average actually lagging the Wilshire 5000, our measure of the general stock market, by a fairly considerable margin over the last 5 years. And that all began to change. We're probably going to talk about this next week at Bull Sessions. That really began to change in the fourth quarter. And by the way, Ken has forbidden me to talk about this, but our best small companies are up like 30% already since Halloween. Shh. Okay, we'll move on. All right. All right, that community of investors known as Better Investing and the stocks that are represented by the 100 most widely held companies by Better Investing, mostly investment club members, pretty solid, checking in, near market performance and certainly a very respectable 5-year result. The 40 most widely followed stocks, companies that are on dashboards that manifest by our subscribers, it really kind of stunned me when I saw it. That's checking in at about 18% over the last 5 years. That is largely fueled by Microsoft, Amazon, and Apple, by the way. Those companies are all resident. Apple is still the most widely followed company at manifest by our subscribers, and that certainly has been a joyful ride over the last 5 years. The average investor, again, nobody here, if you're here today, you don't qualify as an average investor because you're digging in deeper on trying to be better, avoiding hot stock tips. If Ken and I issue a hot stock tip this afternoon, you know that it's not something you should dial a broker and order. You should study it. Anytime we mention a stock, you study it, put it through the gauntlet known as the stock study methods that we basically heartily endorse. The average investor is a performance chaser, a hot stock tip chaser. And that's how they get themselves into so much trouble, and that's why that number's so low. But the number we'll celebrate it one last time tonight. The roundtable has checked in at 22.2% over this last 5-year period. That's our monthly gathering of friends sharing ideas, and we keep track of how well those ideas do over time. Since 2010, the rate of return is 18.4%, but over these last 5 years, it's been 22.2%. So that certainly is a warm fireplace-like moment for me, Ken. How do you feel?
I really enjoy talking about this, Mark, because this is the conglomerate efforts of 4 guys that basically are pretty smart, but aren't professional when it comes to the market. We certainly wouldn't qualify, even yourself, with all of your background, would just barely qualify to be considered in the group of professionals as the professionals consider themselves.
Mm-hmm.
There's a lot of disdain to the private investor, and recently in the media, I've seen the private investor reduced to a caricature of somebody that chases stocks at their own peril on a regular basis. The Robin Hood crew, that kind of thing. And it's a little insulting, but at the same time, here we are proving that it's not necessarily true of all retail investors, that we can do pretty well when we put our mind to it, especially when we consider long-term results. And that's where we've been since the beginning, long-term and patience.
Yep. Yeah, some of that new stuff in the media has kind of gotten under my skin here lately too. They basically issue statements like nobody ever beats the market, none of the professionals, and they're just flat out wrong. And they basically say what the modern investment club movement has done is impossible, or we're lying. They're wrong about that too. And it might be something that gets under my skin enough again that we tackle it as a subject. But for now, I think we just smile, nod. I mean, Ken's in 19 investment clubs. They're all beating the market. And I think we should just celebrate that. Well, you're not quite in 19 anymore.
No, not for a while.
All right, let's spend just a minute talking about a person who is an investment club all of his own, Eddy Elfenbein. I know many of you are familiar with Eddy. He publishes CrossingWallStreet.com is where you can find him. And every year at this time of year, he picks 25 stocks. He usually keeps 20 from last year, dismisses 5, and creates 5 new ones. He basically has beaten the market most of the years and has a really good, strong track record over the last 14 years. I know Eddy personally. I like the way he thinks. I don't always agree with the picks that he puts on this list, but what I can say he is absolutely reliable for is he tends to really excel at picking the medium-sized workhorses, with those medium growth rates for our portfolios. That's where he really thrives. And I've actually used that with individual investing accounts as a source of the medium component. And again, be reminded that we're talking about 50% of all of the above allocation for our investing efforts, and it's a crucial area to be good at. And this is a great place to come. He continuously posts on these companies, much like a member of an investment club might give a report on Church and Dwight, for example. And it's just I think he should be an ad hoc full member of any investment club as a stock watcher for these 25 companies. Have you actually experienced any of Eddy's work inside of an investment club framework, Ken?
Well, no, we don't use it very often, and this is the first time I've looked at this. I'm surprised and pleased. I own 12 of the 25.
I'm not surprised.
I own four of the 5 that he's just added. So I guess I should be pretty happy if he's right.
Yep. In full disclosure, I said I've used him as the medium component for portfolios. He runs an ETF. The ticker symbol is CWS, crossing Wall Street, CWS. And he only changes it every year at this time of year. And I've held shares or units of that ETF now for at least 4, maybe 5 years. So, and like I say, it really tends to be a nice, solid place to go to that you can count on. You can see that there's a lot of stability in that portfolio. Here's a quick look at the dashboard.
Mark, the one I don't own that he just added is Miller Industries. In 2 sentences, is that the heavy duty vehicle company? Is that am I thinking correctly on that one?
Yeah, he says if you're ever towed, if your car is ever towed, chances are it was touched by Miller equipment.
Okay, so I do have the right company then. Okay, I've looked at that one a couple different times. So have some of my clubs, but we've never taken the plunge in that particular one.
I do think that one might be worth a closer look. I don't know how it stacks up here. It's been on quite a run, so Eddy does also do a little bit of momentum-ish type investing. Here you can see from top to bottom. Notice that his, I guess I would first point out, like I was saying, the growth rate is not enormous. It's basically in that mid-range. At 7%, it's these companies basically add up to a company that's to a collective that's on the borderline between medium and large-sized companies. So that's the type of companies that are involved here. You'll notice that he's only got 2 that are in double digits. I love Trex. I've loved it for a long time. I nominated it for Better Investing Stock to Study about 15 years ago. And ANSYS would be the only 2 in double digits. Notice the quality rating of the portfolio, very high quality for these type of companies. If I had a bone to pick with him, it's that the growth rate might be a little bit low in some of those pars. These companies have been on quite a run. So I would probably, if I could, tug on Eddy's ear and nudge him, I would say, maybe go out there and find a few more ANSYS's and Trex's to throw into the mix, but he's got quite a track record. Anything else jump off the page here at you, Ken?
Well, I agree that some of these, I love Heiko, for example. I think that it's a poster child for what a good growth company can do when it's growing, but I think it's over the top of its skis right now, and maybe to the point where it's a little bit top heavy. With only a 3.5% anticipated growth, and that might be a little bit high in my estimation, even if I were doing an SSG. So there's a couple of ones on the list that I still have in my portfolio, but actually Heiko was on my list of let's consider whether we keep it or not moving into 2021.
Mm-hmm.
So
I'm going to take a look and audit some of these. I mean, Heiko might be an example of a company that's getting a boost in expectations from it seems like a turnaround in transition or in progress with a lot of companies, and there might be a little bit of a boost there. I don't know if it's enough to get it into an interesting range. I mean, the most attractive company on here by the basis of its return forecast is Aflac, which is still in the process of recovering from where it was. We'll talk about that a little bit more in a minute, but Aflac is definitely worth a close study. And again, he follows Aflac. He calls it the duck stock, obviously. He follows it pretty closely. So if you're a stock watcher for Aflac, I would invite you to follow Eddy's remarks and commentary on the company. All right. Speaking of Aflac, here's one of the questions from the last 2 weeks. I thought I would do a quick update. And this had to do with the issue of how we at Manifest Investing basically use book value in place of sales for asset-based companies like banks and insurance companies. And same thing Warren Buffett does at Berkshire Hathaway, where we think we're on pretty solid footing. And our analysis is basically that the book value, which is about $46 a share, growing at 10% based on this growth rate, this picture that you see here, with a return on equity that is now somewhere around 10%. You can see that down here. So again, 9.5%, 10% is where that comes from. A PE that's somewhere in that 9 to 10 range, again, by the picture. And I think this is where, when we take a look at Adobe and some of the stuff we were talking about, we might be able to show some pretty interesting stuff. Again, those major components come up with a return forecast, let's call it 10%, a return forecast of approximately 10%. And the return on value, projected return on capital is what it says here, but that should say projected return on value based on their liabilities at $128 billion. But look, folks, they've got $108 billion in the checkbook, and their mortgage is only $7.8 billion. So, I mean, this is not a company with an unmanageable amount of debt. So they actually show a projected return on value. And again, that subject we're going to be spending a lot more time with, right in that 10% time or range. All of these things are pretty good. The return forecast may be a little bit conservative, 6%. So we're looking at a company with a return forecast of approximately 10. So now switching over to what if you look at it like an industrial company. With an industrial company and using a traditional stock study, you would use the sales. So that's what this number is. It's sales. Interesting point about Aflac. Again, take a look at your stock selection guide. There's no growth. I don't know what's going on in Japan. We've talked about this fairly extensively, but virtually no growth, low single-digit growth at best. But their return on equity, their projected net margin has grown to an extremely handsome and robust level. And you basically end up, again, using 9, same type of PE on both sides of the equation, you end up with about 8%, which I say these numbers are the same. So again, whether you treat Aflac as an industrial company and do a traditional stock study on it, calculating a sales figure to work from, or you use the Warren Buffett method of book value and return on equity, basically end up at the same place. And that's not
Mark,
unusual.
I'll give you one reason for what's happening to Aflac. I own Aflac and have owned it for a long time and have resisted getting rid of it. I think that this is an example of an insurance company in the midst of a major shift, not in business model, but in type of business that they do. Mm-hmm. They used to be 100% known for cancer insurance, and in the Far East, Japan especially, specifically. And now I think that if you kind of dig down into their annual reports, you'll find more and more of their business is income.
Replacement.
What do you want to call it? Income. Well, it's picking up medical bills that aren't picked up even by secondary insurance policies. Right. And that's a kind of a model that most health insurance companies don't have. And I think that that's where their business is growing right now. And the growth happens to be in the U.S., not in Asia. So I think that they've managed pretty much to take the business that they're losing in the cancer side of this whole thing and move it to the business that they're gaining in this. It's not a new initiative for Aflac, but it is something that is still growing in the company as far as type of insurance. So I think all in all that accounts for the flat sales number that you see. And at some point, if the trends continue, I would expect to see Aflac begin some minor growth again, maybe 3, 4, 5%. So, and that together with the cash they have and the really nice dividend that they pay gives me a reason to want to hold on to it.
Yeah, and I just checked. Hugh apparently wasn't able to get away and join us for our morning session. He put out the rather intriguing, as he often is, provocative observation that, and it was in the context of talking about what we have learned here in the last year, 2020, with the efforts to battle the COVID and develop the vaccine. There have been some phenomenal things going on. Ken, you were talking about the CRISPR stuff before we got underway here. That's all part of it too. And Hugh's provocative thing is, what if this all leads to a robust development of cancer cures? And he says, and now take a step back and think about all that cancer insurance in Japan. And what would it be like to be an owner of a company that suddenly didn't have quite the liability or requirement to pay out for cancer? And so again, he's just basically offering it as a speculation that it could be a wildly profitable situation to be in if the cure for cancer is found. And he goes on to talk about it being a hedge in his personal portfolio for if they come up with a cure, some of the things that he's invested in actually would lose business. So he looks at it as a hedge, but just a provocative, kind of compelling thought. And we'll leave it to him to explain it further at some future session.
Mark, we're getting a question from Dennis out there, and it's a question that might be on the minds of a number of our listeners, so maybe we should address it real quickly. He wants to know, are the roundtable numbers that you're talking about just based on how each month does, or is this a number that's based on all of the stocks put together in one group? I know the answer, but why don't you expand on that in 3 or 4 sentences to help Dennis out?
Yeah, it would be no different than club accounting or Bivio for an investment club. You're keeping track of every single purchase decision, every single sell transaction. So it's a great big database of the decisions that have been made by the roundtable, and literally calculating the rate of return on that, the big cash flow model or whatever you want to call it. So it's no different than the rate of return that would be generated by Bivio or the club accounting software in keeping track of performance.
Yeah, the only thing that we don't keep track of, we do not take and reinvest any imaginary dollars that might accrue from a sale. That's just cash flow. So it's
cash it
out to track things. We cash it out, but it's just we don't take that money and turn around and add more than we have said we're adding at any particular time. The additions are just $1,000 per name per person, which usually amounts to an inflow of about $5,000 in any one month's roundtable.
Okay, we can perhaps tackle that a little bit later. All right, here's my infamous picture from December. This has to do with an article on RV, recreational vehicle production. They can't keep up with the current demand. And I was inspired to do some field research, went out and rented a 31-footer. So I must get some kind of a merit badge for this, Ken, right?
Or a ribbon, maybe. I don't know, Mark.
I mean, I'm uncomfortable driving a big truck, just a regular, Ford F-150. I actually have driven one of those, Ken. I know you don't believe that, but I have, and I was uncomfortable. This thing drove pretty well, and we had a pretty good time. And yeah, that hose is connected to the tailpipe, so I'm doing it wrong. But this is an article that was featured in 361 Capital's monthly or weekly blog. And there's a link to an actual magazine article because we have family that lives in the Elkhart, Indiana area, and the surge is back. They can't find people to man the production facilities, so they're hiring bonuses, and they're just going full out, having trouble keeping them on the lots. A lot of baby boomers are buying them, so are Gen Xers. And there's actually been a surge in the case of some COVID patients where they have to isolate. They're actually using RVs to do that. Parking it in the driveway and isolating from the rest of the family. So that all those kind of things that are happening, and it's just there as a reminder that, I was inspired by Christmas Vacation and Cousin Eddy.
All kidding aside, Mark, maybe we should eliminate the reference to parking a 45-foot RV in a real public place with regards to what happened in Nashville.
I didn't notice that. I wonder if they wrote this before that happened. Maybe I'll wipe that out of there for when we save the slides, because that could not have been foreseen. We actually went through Nashville recently, and not nice. Thanks for the suggestion, Ken. I hadn't noticed that until just recently. All right, and with that, we will take a few questions when we shut down, but I do show 2:30 or so. Again, I want to invite the people that are attending this. A lot of you have been doing this for a long time. We are going to air this topic out and basically put it through its final throes to see, what value we think it has. In a fairly extensive research, we calculate the projected return on value on every single company, which, by the way, we're back to 2,500 companies, Ken, in the manifest database. And that's not easy to do considering you lose 2 or 3 every week. We calculate this number on all of those, and basically are watching them continuously and trying to see what value we can derive from this. We think it has considerable potential. We had 2 or 3 programs on this over the last few months. We had an entire session dedicated during the Successful Investing Conference. I'll show you where to look for that in a minute. But you can read the bullet points on the right there. We think that it captures all of the power of the traditional stock study method that's been put out there by George Nicholson in Better Investing, and perhaps removes some of the vulnerabilities, or perhaps provides an enhancement. This is the type of stuff we're going to be looking at more carefully. One of the things I find fascinating is it is a bit of a return. Did you know that stock selection guide on the left is actually from the first edition of Better Investing magazine? It was called the NAIC Bulletin back then. And back in those days, they graphed only the sales and the pre-tax earnings on the front side of the chart. So that would be the green and the magenta lines on a current day stock selection guide. That's all that was on the front of the guide. It literally bringing section 2A to the front. And one of the interesting potentials that this might provide for us, it's actually a 2-dimensional thing. It might actually augment or enhance the formation of PE estimates, almost like an audit or a second check, or I'll let Ken expound on that a little bit in a minute. The other thing is you're basically looking at an analysis of projected return type number that does not include PE anywhere in the calculation. And the numbers that are in that formula up at the top, again, you're taking the pre-tax income, the projection 5 years out, and dividing it by the enterprise value. This is the formula for enterprise value in the denominator here. So the stock price, and that could just as easily be per share, but we always think of stock prices per share. The total liabilities, not the total debt. That's where long-term debt, that's where we started this effort 6 months ago. The much better option is to look at total liabilities and then also account for the cash per share on the balance sheet. So when you see us doing a calculation like this one for Aflac, we're basically looking at the stock price, the total liabilities, the cash on hand, which is considerable in the case of Aflac. The tax rate is what you use to go from net income to pre-tax income, and basically pump those into that formula and come up with that projected return on value. So I think it's a return to some very important roots and some of the most significant analytical power of the stock selection guide. That's my opinion at this point, and we're going to really hammer away at this and make a decision here in the first quarter. I guess this is a resolution, Ken. Make a decision as to how we present this and make it available on every company report page at Manifest if we deem it helpful, supportive.
Well, what's so important, Mark, about every single number that we reference on the stock selection guide and on the manifest method and everything is setting guidelines for when those numbers are in line and when those numbers should be further examined and what are the numbers telling us. And so that's the second half of the puzzle. We're certain that there's something here in this proof idea. Now what we have to do is come up with some really good guidelines about how you can tell when proof should be, when is it telling us something different than what par is telling us? When they're basically the same, that's validation for par. But what is it telling us when they're really widely split, wide apart? And how far is wide? How far is the English word wide mean? Is it 50% higher or 50% lower, or is it 100% higher or lower? So when we can start to come up with those guidelines that will work, even if they work only 3/4 of the time, it's going to be an extremely powerful tool for us to use then.
Yeah, and I'm reminded, again, speaking of 2020 and some of the moments that sucked about last year, we did lose Nick Strategos last year, a dear friend to all of us. And Nick and I actually had done some work back in July or August in one of these sessions where we had talked about, he saw the potential value, and it's actually something that Ken has zoomed in on as an audit of the PE process for selecting and projecting a PE. And that's something that I think we need to cover. Nick was all over that. He thought that was something of fairly high potential, and it took some of the exuberance out of some of the studies that were, perhaps a little bit questionable or a little bit uncomfortable. And we look forward to that. The other thing that it does is, especially in today's world, with all of the debt being taken on and equity being replaced with debt capital, it accounts for that. And it accounts for that better than something based solely on the income statement. So that's a good thing. Here's a look at what we're talking about measuring. And again, this should be fairly intuitive and obvious to many of us. When you do a stock selection guide during a stock study, you are out there thinking about, what do the next 5 to 10 years look like? You're forming those 5-year estimates. And what you see on your screen is literally that picture from side one. Only in this case, we're thinking very carefully about what that pre-tax income might be 5 years out, because that would represent an average return, average annualized return over the next 10 years. And fairly powerful component. So again, we just leave you with this thought. The enterprise value should be very interesting. We're going to air out a question from 20 Questions with Tom O'Hara within the next couple of weeks and really dig into this. But some fairly interesting stuff, and we have an extra cheerleader in this one in Joel Greenblatt and his success over a lifetime of investing, focusing on very comparable topics. Okay. All right. We have been highlighting some of our favorite books, and I've been brushing over this one. I'm going to stop brushing it over, and we'll add it. And I don't know if we're going to have a whole lot more books again, but we'll add them if one comes up over time. But the one that I wanted to share just a few minutes talking about here today is a book that I found as a result of the work where's the book on here? It was the book by Investing at Level 3 by Jim Clunan over at the American Association of Investors. Investing at Level 3, kind of geeky, some really good stuff. And I've written fairly extensively about how comparable Clunan's book is in many ways with the works of George Nicholson, believe it or not. And in part of that, Investing at Level 3, he made reference a number of times to this book, Excess Returns. And it's a pretty heavy book, but just like it says on the right, it went out and looked at successful investors. This comes back to that thing we were talking about a few minutes ago about the media trashing people and saying nobody can beat the market. Well, there's a bunch of names that did, and did it for decades. You know, Warren Buffett, Benjamin Graham, Bolton, I do not know very well, Peter Lynch, Charlie Munger, Joel Greenblatt, Lou Simpson, you see the names there. Einhorn's had better years. He's actually had a couple fairly slumpy years here lately. But the book I thought was going to be just a case study after case study, you know, broken down chapter by chapter. It really isn't. It's going in and taking a look at the stuff. You know, some of the stuff would actually be at least a first cousin to projected return on value. A lot of the stuff would be consistent with the work of David L. Babson in the early days of the modern investment club movement. You could put Babson and Price on that list. But I found it to be pretty heavy, but for those of you that really want to geek out and dig in, I highly recommend taking a closer look. And I'll probably go back and spend a little bit of time. Ken, had you actually taken a look at this one yet or not?
I have not looked at this one at all, but Mark, I have done some thinking. You asked me a couple days ago, did I have any books to add to the list? And I responded pretty quickly. I said no, but I've been doing some thinking in the last 48 hours or so. And I looked at my bookshelf and was amazed to see that I had 3 books, all of them fairly slim, all of them written in real simple English. And the titles were pretty much the same. They were basically, how do you read a financial statement, or how do you read an annual report? And they were 100 or so pages of business speak, becoming familiar with some of the definitions and some of the references that were made. And I think I'm going to get you the names of just one of my 3 books at random here, because I think that without an understanding of some of the basic business vocabulary, I think reading some of these books become quite challenging. But when you understand what a balance sheet is, for example, when you understand how the balance sheet can be tied pretty quickly to what you're doing in manifest investing, or what Better Investing does on a stock selection guide, things become much clearer. In fact, they become crystal clear if you really sit down and think about what all the lines mean and what vocabulary translates to them. So I think maybe a real basic book like that should be on our library list as well. So I'll get you the name of one of those for our next bull session.
I'll dig in and we'll add those and display them next month. One of the fun facts that I do like to point out with everybody, especially those of you that have been around and in this community for many years, in the NAIC Investors Manual, I think all of us recognize that I would say 95% of the engine behind the stock selection guide is the income statement. And that might be low. What I find fascinating is that if you actually turn the pages of that book, George Nicholson starts chapter 1 on the balance sheet. And he spends the entire foundation of the book setting up, you got to get the balance sheet right first. And that's kind of cool. And again, that comes back full circle to this notion of projected return on value and the capital allocation stuff that Kim talks about. It all is very helpful to an investor trying to understand this stuff. So good stuff. All right. For those of you that aren't aware of this, at YouTube, you can just search Manifest Investing. You'll end up at this page. You can actually subscribe if you'd like to to receive updates about when we put stuff out. We do post all of the bull session recordings and all of the roundtable recordings here at the page. I suspect that'll continue for some time until we get tired of YouTube. There are almost 10 years of material there. We were talking a few minutes ago about this projected return on value. We lovingly refer to it as PROVE. There's an entire 1-hour session Ken and I put together back for that session in mid-December? Mid-November. Mid-December, a little while ago. November 2020. I'll reel it in if I keep working at it. But that entire session gives you an update on where we were at the time on this projected return on value concept, if you want to take a look at that. With that, we will go ahead and invite you to tonight's session on the roundtable. Again, that is the portfolio that has delivered a 22.2% return over the last 5 years, over 18% over the last 11. And any thoughts on this one, Ken?
Well, I invite everybody to come. It's absolutely free. And if you can't find a link, if you're a Manifest subscriber, the link is right under events, right from the homepage of Manifest Investing. If you're not a Manifest investor, why not, first of all? But secondly, drop an email to nkavula1@comcast.net, and we'll try to send you a link right back so that you can register and attend this evening.
All right, and we'll be raising the glasses and maybe some fireworks going off. And then one of the magic moments from 2020, the Academy Awards last year, when the winner of the Academy Award for Best Picture committed to celebrating until the sun came up. And that's not a bad aspiration sometimes at all. All right, and we'll leave you with, again, in our final broadcast of the year 2020, at least with respect to bull sessions, our wish for all of you that you experience best wishes and better investing. That is an image of Epiphany Lake on your screen, which is kind of our theme over the next approximately 10 days. So best wishes and better investing. Thank you, Ken. And thank you for all joining us here today.
Great year. Thanks for a great investing year, and may 2021 give us the same kind of success, just without all the headaches.
I'll second that and say amen. All right. Thanks, everybody.